Thanks for the question, Jeremy. Let's see what you got to say.
Hey, Brad, this is Jeremy Nelson. I've been in on a few live streams recently, and first just wanted to thank you for taking your time to share some of your experience and knowledge. I've learned a lot already and I'm excited to learn more. Question for you is on the wheel strategy and how you manage both sides of the wheel. So as I'm looking at it, it seems like potential downside of the wheel is that only half of it is capitalizing on the appreciation of the underlying stock. So when you're writing a call, you get both the premium as well as some of the growth of the underlying stock. But when you're writing put, you only get the premium and maybe even lose out on some of the appreciation of the stock. So when managing each side of the wheel, it would seem like it makes most sense to try to reacquire and keep the shares as much as possible, maybe rolling your calls so that you maximize gains through appreciation while writing puts with the intention of getting assigned as quickly as possible so you don't lose out on any of those that appreciation. Curious if you have any thoughts or recommendations on how you manage both sides of the wheels and how you pick strike prices and decide when to roll or how to manage assignment. Or if it makes sense just to skip the put altogether, maybe buy back your shares right away so that you can kind of maintain and keep those shares as much as possible. Thanks.
I'm glad you mentioned that at the end because that's definitely one of the options. And it's funny, in my evolution of the wheel, when I first made the wheel strategy videos, man, maybe 2 years ago now, I started making them. I used to treat the call and the put as like equals. Then I learned a lot. I learned a bunch, and I really found some like hatred for the put for some reasons that you talked about that I definitely will reiterate. I started to hate the put, and I would do exactly that. When I got assigned, I would just buy the shares back because I wanted to own them. And I wanted to own them mostly, not even for their capital appreciation that you talked about. I wanted to own them because I was doing this primarily with the dividend stocks, right? And when you sell a covered call, you own the shares. And even if you have a contract out on them, you still collect a dividend. You own the shares until they're assigned, right? Which is kind of why you want to avoid ex-dividend dates when we're selling calls. And on the put side, you don't get that. So I'm like, why would I could get some premium, but I mean, all I'm getting premium-wise, all I'm getting in the cash or put is that premium. Where if I do this and I sell calls, I get the capital appreciation you mentioned up to the strike that I choose. So I know, like, if I get assigned shit, I know I'm going to make this amount of money. That's awesome. Where on assignment of a put, you don't necessarily know that. So it's hard to, like, factor in that capital appreciation into your thought process. And you don't get the dividends. So I had some hatred for the puts, and I was doing that. Now I've kind of evolved to understanding the put side and finding more love for not necessarily the cash secure put in the wheel, but just puts in general. All right. And here's kind of what I mean. When I made these videos, I talked about how you can start anywhere you want with the wheel. You can start with the cash secure put, or you can start with the call. And I still feel that for the wheel strategy, I want to start with the call for two reasons. One, the things we discussed already, capital appreciation and dividends if you're doing them with dividend stocks. Here's another reason why I like to start with the call. Not everyone, you could just go out and just, boop, I own 100 shares. I'm just going to, you know what, I'm going to buy 100 shares today of this stock. We don't always have that. So instead of like saving up money for the collateral to buy the put or to write the put option, you're going to take some time and you're going to build up to 100 shares over time. This is an amazing time to educate yourself on other wheel strategies, ways to benefit the Greeks and things like that. It doesn't force you right into options trading. So you kind of like build up your 100 shares, you keep doing your research, and then you get all the benefits of it. So I still feel strongly that like with what I wheel with, I have most of the stocks I can go in. If I have the collateral to write the put, I can just buy the shares. So I'm just going to buy them, or I'm going to build up to them. I'm going to start with the call. This could be bad if it shoots up really high, and we know like the con is you are going to lose potential growth above your strike price. Okay. That definitely is a con. With the put now, I've realized that I love the put so much, or I'm learning to love it so much, and I think I'm going to do a cash secure put video soon, is I love that set it and forget it guaranteed premium. So outside the wheel. I never thought that I would write puts outside the wheel before. But as I talk to wealthier people, and as I talk to people that are just killing it in the investment game, I find out that instead of owning shares, especially in this like inflated bubble type market, they just have millions of dollars, literally millions of dollars of collateral out there, and they're guaranteeing themselves a return on their investment. And if for whatever reason it gets assigned, they got their stock at the value that they wanted, and then they could start the wheel. So to be honest, I've been doing puts long term. I've been selling puts expiration far out, and I'm going to do a video about this, so that's good. I'm going to do a video about it. And I'll tell you, like, because that guaranteed, I used to think that puts was like, I don't want to tie up my collateral that long. I said that. That's been a reason why I didn't like to put, you got to tie up all this collateral. Well, if you buy 100 shares, you got to tie up all that cash to buy the 100 shares. I don't know why I didn't like think of that. It was like so dumb of me. But if I wrote a put for 6 months out from now, and I knew the collateral I had to put up, and I knew how much premium I was going to return, I can calculate my return on investment immediately, and then I can multiply that by 2 to get my yearly return on investment. So take, for example, Intel. I know it's already a value stock. Many value investors and value channels have talked about how it's a good value, or a good value, especially a good value at a certain strike. So if I write my strike for $50, right? That means I own $5,000 in collateral, okay? If I know that I'm going to make, say, 8% back in premium, what that means is that I either get Intel at the price that I wanted, and I had to buy 100 shares, no big deal, the collateral's already out there, or it's going to expire worthless, and I guaranteed myself 8% return, which is a 16% annual return on investment. Now, I know there's a lot of YOLOs out there selling NFTs and things like that, but at my age, at 40 in March, I'll take 16% on my money all day long and twice on Sunday. So that's why I love puts now. There's definitely more opportunity to see your wins on the call side. There definitely are. And that's for, like I said, I'll reiterate, I would probably, the stocks that I am wheeling, there's a few. Now, am I essentially wheeling Intel? Yeah. But I started with the put on a 6-month timeline, right? I tied up that collateral for that long. I pretty much said, hey, how about I give you $5,000 and you give me 6% back? That's what I did. You know, and for a while when I was super excited about the wheel and I was hearing about all the numbers and I knew the numbers, I'm like, F it, I'm not taking 6%. I can get 10% a month. I'm not taking 6% over 6 months. F that. But now I'm like older and I'm like, let's start to hedge some of this money. I got this money in cash. Why not use that cash as collateral to guarantee myself 6%? This pretty much is that put video, I guess, without the math. Maybe I'll come in and drop the math. But yeah, without babbling and saying it again, I'm for the call side to begin the wheel strategy. But I don't hate the put as much. If in 6 months Intel got assigned, I would buy those 100 shares at $50 each. Depending on if I have to bag hold them or not, I'm going to write calls against it. And on the call side, this is another great thing about starting the call. You mentioned, like, how do we determine strikes? When you write a put, you have to determine what a fair value is. You have to come up with the strike price and the strike price that you think is best. When you sell calls, your basis is your line. That's it. It's done for you. What is your average cost per share? Make sure your strike is above that, because then you automatically profit, right? So it's also great for beginners to start with the call side because your strike price is almost done for you. Now, if you want to get fancy and throw in delta and be like, I want to write my call with a delta smaller than 0.4 or 0.3 or whatever you want, great. But essentially the long and short of the covered call is as long as your strike price is above your basis, good. Good. Especially if you factor in, like if it's a dividend stock and you factor in, losing a dividend if you were in an ex-dividend date. Don't write calls on the week of an ex-dividend date, but that's also done for you. So if you're a beginner, maybe you don't know how to value a stock. Maybe you don't know $50 is a good price for Intel. But if you build up and at the end you say, oh, my cost per share as I bought these shares over time is $52.50. Okay. Well, what should my strike price be? Anything greater than $52.50. And then when you get assigned, well, what should the strike price be on the cash or put? $52.50, whatever that $52.50 was, so that your basis doesn't change, right? If you get assigned at $55, the put goes at $55. Now, sometimes if there's major swings, which we don't want to do with wheel stocks, you might have to back hold for a little bit. You might have to do it, And if the strike price shoots up past your call and you get assigned, and you don't feel comfortable writing a call, or you don't have the collateral to write the call, then you got to wait or choose a new stock. That's happened with me. It happened with AbbVie. I used to wheel with AbbVie, and I had a call price that was way above my basis. The delta was like 0.3. I was happy, and AbbVie went like this, shot up. And I said, damn, I don't have an extra. It went up $6 past my strike. I didn't have another $600 to write the call. So that was the end of the day with AbbVie. Kept them on my watch list. Said, hey, if it comes down to my basis, maybe I'll start to write puts on it again. I don't think it ever did, or I moved on to greener pastures. But it's a great question. It really is, and that's really what you need to think about. Wheel, I'm still for starting with the call. It gives you your strike price. It allows you to collect dividends, and it allows you to find out exactly how much profit you are going to take if you get assigned. But please, especially if you have, or you're sitting on cash, or you're trying to diversify a little bit, don't fear the put so much, and think long term. Think to yourself, if I do a monthly put, if I write a cash or put, and I get 2%, that's a 24% annual investment on your money. That does not suck.